In the quiet corridors of central banks and the sealed vaults of international finance, a transformation is unfolding, not with the thunder of war, but with the silent compounding of debt. Trillions upon trillions of dollars, euros, yen, and yuan have been conjured into existence over the past 2 decades, not through productivity or innovation, but through promises stacked upon promises, guarantees layered over guarantees. Now, as interest rates climb, currencies wobble, and trust in institutions frays, a long-dormant mechanism of financial history is reactivating. It has no single architect, no declared start date, and no official name, but historians will one day call it the Great Debt Reset. And it is accelerating faster than almost anyone realizes. This is not the first time humanity has stood at this precipice. Empires from Rome to Spain to Britain have all faced the moment when their debts outstripped their ability to repay, conceal, or inflate away. What distinguishes our era is not the scale of the debt alone, though it is unprecedented, but the globalized, digitized, and deeply interconnected nature of the system that now bears its weight. Where past collapses unfolded over decades, today's architecture of credit, derivatives, and cross-border liabilities could transmit failure at the speed of light. The stakes are not merely economic, they are civilizational. The stability of nations, the cohesion of alliances, and the purchasing power of billions hang in the balance as the reset gathers momentum. To understand where we are, we must first understand how we arrived. The roots of the current debt supercycle stretch back to the aftermath of World War II, when the Bretton Woods system enshrined the US dollar as the world's reserve currency, backed by gold and American industrial might. But by 1971, President Nixon severed the final tether between money and metal, unleashing a new era of fiat finance. From that point forward, debt was no longer constrained by real assets. It was constrained only by confidence. And confidence, as history has repeatedly shown, is a fragile thing. The true acceleration began in earnest after the 2008 global financial crisis. Confronted with systemic collapse, central banks led by the U.S. Federal Reserve initiated quantitative easing, a polite term for digitally creating money to buy government bonds and mortgage-backed securities. The balance sheet of the Fed, which stood at under $1 trillion in 2007, ballooned to over $9 trillion by 2022. The European Central Bank, the Bank of Japan, and the People's Bank of China followed suit, collectively expanding global central bank assets from roughly $10 trillion in 2008 to more than $35 trillion by 2022, according to Bank for International Settlements (BIS) data. This flood of liquidity rescued banks and markets, but it also distorted pricing, inflated asset bubbles, and detached fiscal reality from monetary policy. Governments, sensing the ease with which deficits could be monetized, abandoned restraint. The U.S. national debt, which took over 2 centuries to reach $10 trillion in 2008, has since nearly tripled to over $35 trillion by late 2024. Yet the deeper story lies not in the numbers alone, but in the precedent they echo. Consider the Weimar Republic. After World War I, Germany was burdened with reparations that exceeded its capacity to pay. When it defaulted, French and Belgian troops occupied the Ruhr Valley in 1923. In response, the German government printed marks to pay striking workers, triggering hyperinflation that wiped out the middle class and paved the way for extremism. Or examine the British Empire after World War II. Once the world's creditor, it emerged from the conflict drowning in debt, forced to abandon its colonies and cede financial primacy to the United States. Even the fall of the Roman Empire was preceded not by sudden invasion, but by centuries of debasing the denarius, reducing its silver content until the currency became worthless, eroding tax revenues and military loyalty alike. One of the most revealing episodes in this lineage is the 1970s stagflation crisis, meticulously documented in Fed archives and recounted by economists like Alan Meltzer. After the dollar's gold link was severed, the floodgates opened. Oil shocks, wage price spirals, and loose monetary policy collided to produce a decade of economic malaise. The resolution came not through gentle adjustment, but through brutal medicine. Paul Volcker, appointed Fed chair in 1979, deliberately triggered a recession by raising interest rates to nearly 20%, crushing inflation, but also throwing millions out of work. His actions saved the dollar, but they also demonstrated a recurring truth. When debt and money lose credibility, restoration demands pain, and the greater the accumulation, the sharper the reckoning. The mechanics of today's debt architecture are both elegant and perilous. Sovereign debt, once a tool of wartime finance, has become a permanent feature of peacetime governance. Governments issue bonds denominated in their own currency, which central banks purchase using newly created reserves, a closed loop that appears sustainable until it isn't. But this system depends on 3 pillars: the willingness of foreign creditors to hold debt, as Japan and China have done with U.S. treasuries, the stability of domestic banking systems that intermediate this debt, and the credibility of a central bank's inflation-fighting resolve. All three are now under strain. Foreign holdings of U.S. treasuries peaked in 2015 and have declined steadily as geopolitical rivals diversify reserves. Domestic banks, laden with long-duration bonds purchased during the zero-rate era, face mark-to-market losses as rates rise. Witness the 2023 collapses of Silicon Valley Bank and Credit Suisse. And central banks, caught between inflation and recession, are losing public trust. A 2023 Pew Research study found that only 22% of Americans expressed a great deal of confidence in the Federal Reserve. Worse still, the world is fragmenting along currency blocks. The US dollar still accounts for nearly 60% of global reserves according to IMF COFR data, but its share is declining. BRICS nations, Brazil, Russia, India, China, and South Africa, are increasingly settling trade in local currencies. Russia and China conduct over 80% of their bilateral trade without dollars, per Russian central bank reports. Saudi Arabia, once the linchpin of the petrodollar, now accepts yuan for oil. These are not symbolic gestures. They are structural shifts that erode the dollar's exorbitant privilege, the ability to borrow cheaply in its own currency while exporting inflation abroad. As that privilege wanes, the cost of servicing America's debt will rise, forcing either draconian austerity, monetization, which fuels inflation, or de facto default through currency depreciation. Behind these tectonic shifts operate institutions that rarely speak in public but shape outcomes in private. The Bank for International Settlements in Basel, often called the central bank of central banks, has long warned of the dangers of excessive leverage. In its 2006 annual report, years before the crisis, it flagged the underpricing of risk in global markets. The IMF, meanwhile, has quietly facilitated debt restructurings for emerging markets from Argentina to Zambia, often imposing conditions that favor Western creditors, and private financial titans, BlackRock, Vanguard, and others, now hold such vast stakes in global equities and bonds that their risk models influence market stability itself. These entities are not malevolent conspirators, they are rational actors operating within a system that rewards short-term stability over long-term solvency. Their collective behavior, however, creates a feedback loop. As debt grows, they demand more collateral, which requires more borrowing, which increases systemic fragility. And now the reset is accelerating. The turning point came not in 2008, nor even in 2020 during the pandemic money surge, but in 2022, when inflation returned with a vengeance after decades of dormancy. Suddenly, the illusion that debt could grow infinitely without consequence evaporated. Central banks reversed course, hiking rates at the fastest pace since the Volcker era. But unlike the 1980s, today's governments are far more indebted. U.S. interest payments alone surpassed $1 trillion annually in 2024, more than the defense budget. In Europe, Italy's debt-to-GDP ratio hovers near 140%, with refinancing needs exceeding $200 billion per year. Japan, long insulated by domestic savings, faces a demographic cliff. As its population ages and shrinks, fewer workers must service the world's highest debt load, over 260% of GDP. This is the acceleration phase, not a sudden crash, but a series of cascading pressures that tighten like a vice. Bond markets, once docile, are now volatile and skeptical. The yield curve has inverted repeatedly, historically a reliable recession predictor. Gold, the ancient store of value, has surged past $2,300 per ounce, not because of speculation, but because central banks from Poland to China are accumulating record amounts, signaling distrust in fiat alternatives. Meanwhile, digital currencies, both state-issued and decentralized, are gaining traction as alternatives to a strained system. The people, yes, a Bank of China has already rolled out the digital yuan to over 260 million citizens. The European Central Bank is testing a digital euro. These are not merely technological upgrades. They are tools of financial control and sovereignty in a post-dollar world. The great truth emerging from this turmoil is this. Debt is not just a number on a balance sheet. It is a claim on the future. Every dollar borrowed today is a promise to extract resources, labor, or value tomorrow. When those promises exceed society's capacity to fulfill them, the system must reset. Historically, this has occurred through four channels: inflation, eroding the real value of debt; default, reneging on promises; austerity, crushing growth to generate surpluses; or war, destroying old orders and creating new ones. We are now cycling through the first three simultaneously, an unstable cocktail that increases the risk of the fourth. The architects of the post-1945 order believed they had tamed these cycles through institutions, rules, and cooperation. But human nature, imperial ambition, and arithmetic are relentless. The debt mountain cannot grow forever. The question is not whether the reset will happen. It already is. but how orderly or how chaotic it will be. We stand at a hinge moment in financial history, one that will be studied for generations. Will the world engineer a managed transition, perhaps through a new monetary accord, a debt restructuring framework, or a reformed reserve system? Or will it lurch from crisis to crisis, as nations prioritize survival over cooperation and currencies fracture into competing blocs? The lessons of Rome, Weimar, and Bretton Woods whisper the same warning. Trust, once lost, is nearly impossible to regain. And money, at its core, is nothing more than shared belief. When that belief fractures, everything built upon it trembles. The tremors are already visible, not in headlines, but in the quiet recalibrations of power beneath the surface. In 2023, for the first time since the 1970s, the U.S. Treasury failed to attract sufficient foreign bids at a 10-year note auction without aggressive intervention from primary dealers, many of whom are themselves reliant on central bank liquidity. This moment, buried in auction data but noted in internal Treasury briefings, marked a threshold. The era in which the world automatically absorbed American debt simply because it had no alternative was ending. Simultaneously, China's foreign exchange reserves, long held as a buffer against capital flight, began shifting from treasuries into physical commodities: copper, lithium, and most tellingly, gold. By mid-2024, China's official gold holdings had doubled from 2020 levels, a move mirrored by Turkey, India, and even Poland. These are not speculative bets. They are strategic hedges against a future in which paper promises may not be honored, or may be honored in currency so debased as to be meaningless. This strategic retreat from dollar hegemony is not occurring in isolation. It is part of a broader re-engineering of global trade and finance. The de-dollarization trend, once dismissed as rhetorical posturing by emerging powers, has evolved into concrete infrastructure. The BRICS payment system, launched in 2023, now links real-time settlement mechanisms across 5 continents, bypassing SWIFT in over 30% of intra-block transactions. Russia, cut off from Western finance after the invasion of Ukraine, has not only survived, but thrived through alternative trade corridors, shipping oil to India in rupees, buying Chinese machinery in yuan, and using UAE banks as intermediaries. What began as emergency adaptation is hardening into permanent architecture. Meanwhile, the Gulf states, long the dollar's staunchest allies, have begun negotiating oil contracts in multiple currencies. Saudi Arabia Ur's 2024 agreement to accept Chinese yuan for a portion of its crude exports to Asia was not merely economic, it was geopolitical. It signaled the end of the 1974 petrodollar pact's absolute dominance, a cornerstone of American financial supremacy for half a century. At the heart of this shift lies a fundamental asymmetry in the global monetary system. The United States prints the world's money, but other nations must earn it. For decades, this arrangement functioned because the U.S. ran current account deficits, recycling dollars through imports, military spending, and financial markets. But as fiscal discipline eroded and political polarization deepened, the reliability of the dollar as a neutral, apolitical medium of exchange came into question. Sanctions against Russia, Iran, and Venezuela, while strategically justified from Washington ES perspective, revealed the dollar OUS double edge. It could be weaponized. For nations outside the Western alliance, holding vast reserves in a currency that could be frozen at a keystroke became a liability, not a safety net. The 2022 freezing of $300 billion in Russian central bank assets was a watershed. As Harvard economist Jeffrey Frankel noted in a 2023 BIS working paper, but once you demonstrate that reserves are not truly sovereign, you destroy their function as insurance. The message was received. Reserves are now being diversified not just into gold, but into bilateral swap lines, local currency pools, and even strategic commodity stockpiles. This fragmentation is accelerating the debt reset on 2 fronts. First, as demand for U.S. Treasuries wanes, yields must rise to attract buyers, increasing the cost of servicing America's $35 trillion debt. Second, a weaker dollar inflates the price of imported goods, reigniting inflation just as central banks attempt to cool it. This creates a policy trap. Raise rates further to defend the currency, deepening recession, or pause hikes to support growth, risking a dollar collapse. There is no clean exit. The same dilemma confronts Europe, where the Eurozone's structural flaw, monetary union without fiscal union, leaves it vulnerable to sovereign debt spirals. Italy's 2024 budget deficit, projected at 5.8% of GDP, has triggered renewed tensions with Brussels and Frankfurt. The European Central Bank, already holding over $5 trillion in bonds, faces the specter of another sovereign debt crisis, but this time without the political cohesion to backstop it. Yet the most dangerous vector of acceleration may lie not in sovereign debt, but in the shadow banking system. Beyond the regulated banks, monitored by the Fed and ECB, operates a vast network of money market funds, repo markets, hedge funds, and structured investment vehicles that now intermediates over $200 trillion in global credit, roughly twice the size of the traditional banking sector according to FSB 2024 data. These entities operate with minimal capital buffers and rely on short-term funding to hold long-term assets. In normal times, they lubricate markets. In stress, they amplify it. The 2019 repo market seizure and the 2023 U.S. regional bank collapses both originated in this opaque layer. Now, as rates stay higher for longer, the mismatch between asset duration and funding maturity is straining balance sheets worldwide. A sudden liquidity crunch in this system could cascade through global markets faster than any regulator could respond. This is where history offers its darkest parallel, the 1931 Kreditanstalt collapse. Austria's largest bank, deeply entangled with industrial conglomerates and Eastern European debt, failed not because of poor lending alone, but because its interconnectedness transmitted shockwaves across Europe. Within months, bank runs erupted from Budapest to Berlin, forcing countries off the gold standard and triggering competitive devaluations. The global economy fractured into protectionist blocs, setting the stage for geopolitical confrontation. Today's financial system is far more interconnected and far more leveraged. A major sovereign default by a mid-sized economy like Turkey or Argentina could ignite margin calls across the shadow banking network, freezing interbank lending and triggering fire sales. The BIS has repeatedly warned of this liquidity illusion, noting that in times of stress, markets that appear deep and liquid can evaporate overnight. The hidden architects of the current trajectory are not shadowy cabals, but technocrats operating within well-documented incentive structures. Central bankers, judged on inflation and employment mandates, have been forced into unprecedented activism, buying corporate bonds, mortgage securities, even equities in Japan. Finance ministries, pressured by aging populations and rising entitlement costs, have normalized trillion-dollar deficits. Private financial institutions, driven by quarterly returns and asset under management fees, have lobbied for deregulation and low rates. Each actor behaves rationally within their domain, yet collectively they have engineered a system that is unsustainable at scale. The tragedy is not malice, but misaligned incentives compounded over decades. As economist Hyman Minsky observed in his financial instability hypothesis, stability itself undermines stability. Periods of calm encourage risk-taking, which sows the seeds of the next crisis. And so the reset accelerates, not with a bang, but with 1,000 quiet defaults, devaluations, and reallocations. In the U.S., student loan forgiveness and mortgage modifications are stealth forms of debt cancellation. In Europe, perpetual temporary ECB bond purchases mask fiscal transfers. In emerging markets, local currency redenominations and capital controls reappear under new names. None of this is illegal or even covert. It is simply the path of least resistance when formal restructuring is politically impossible. But this incrementalism has consequences. Each intervention distorts markets further, eroding price discovery and rewarding moral hazard. The longer the system is patched, the more violent the eventual correction. The revelation, then, is not that a debt reset is coming, it is that it is already underway, disguised as normal policy. The world is not waiting for a grand conference at Bretton Woods II. It is improvising a new order in real time through bilateral deals, digital ledgers, and physical gold bars. The winners will be those who recognize that money is no longer just a medium of exchange, but a domain of strategic competition. The losers will be those who assume the old rules still apply. What makes this moment uniquely perilous is not the existence of debt. Civilizations have always borrowed, but the unprecedented fusion of financial, technological, and geopolitical volatility. In past eras, debt crises unfolded in relative isolation. A sovereign default might trigger a banking panic, but communication delays and capital controls contained the contagion. Today, algorithms trade $6.6 trillion in foreign exchange daily, a figure that exceeds global GDP in a single month, and they react to headlines, not historical context. A tweet, a central bank whisper, or a satellite image of port activity can trigger portfolio reallocations that move markets before a human analyst has finished reading the report. This velocity amplifies error, erodes deliberation, and compresses the timeline between stress and systemic rupture. The great debt reset is not just accelerating, it is becoming algorithmically urgent. Consider the role of artificial intelligence in modern debt markets. Since 2021, quantitative hedge funds and central bank trading desks have deployed machine learning models trained on centuries of economic data, from Venetian ledgers to Weimar bond yields. These systems do not understand history, they detect patterns and correlations, and one pattern dominates. When debt-to-GDP ratios exceed 250% and interest costs surpass 5% of government revenue, default or devaluation follows within 3 to 5 years. The models see the US, Japan, and Italy flashing red. Their response is not to sound alarms, but to reposition portfolios, selling duration, buying volatility, shifting into hard assets. This automated capital flight is already underway. not in dramatic headlines, but in the quiet outflows from long-duration bond ETFs and the surge in gold-backed digital tokens. The market is voting with its algorithms, and it is not optimistic. Meanwhile, the geopolitical chessboard grows more treacherous. The US-China rivalry is no longer confined to trade tariffs or semiconductor bans. It has entered the monetary domain. China's cross-border interbank payment system, CIPS, once a niche alternative to SWIFT, now processes over $100 billion daily, up from $20 billion in 2020. More importantly, it is integrated with China's Belt and Road Initiative. Loans to Pakistan, Ethiopia, and Argentina are increasingly denominated in yuan and serviced through CIPS-linked banks. This is debt diplomacy with a financial backbone. When Sri Lanka defaulted in 2022, it was not just a fiscal failure, it was a demonstration of how debt can be leveraged for strategic access, as Colombo handed China control of the Hambantota port. Now, over 60% of Belt and Road loans are non-concessional, meaning they carry market rates and hard currency clauses, making them vulnerable to the very debt distress they were meant to alleviate. The cycle is self-reinforcing. As nations struggle to repay, they offer concessions, ports, mines, data rights that deepen dependency and alienate Western partners, pushing them further into the yuan orbit. This is the new battleground of empire, not tanks on borders, but balance sheets in boardrooms. The United States still holds immense advantages, the depth of its capital markets, the rule of law, and the dollar's network effects. But these are being tested. In 2024, for the first time, non-dollar bonds accounted for over 40% of new sovereign issuance in emerging markets, according to the Institute of International Finance. Even traditional U.S. allies are hedging. France and Germany now settle over 25% of their bilateral trade in euros, avoiding dollar conversion fees and surveillance. The UAE and India have launched a rupee dirham trading corridor. These are not symbolic gestures. They are the slow erosion of a monetary monopoly that once allowed the U.S. to run deficits with impunity. And yet, the most insidious force driving the reset is time itself. Demographics are destiny and debt dynamics, and the world is aging faster than at any point in human history. By 2030, 1 in 6 people globally will be over 65, up from 1 in 11 in 2019 per UN projections. In Japan, 29% of the population is already over 65. In Italy, it's 24%. These societies face a cruel arithmetic. Fewer workers supporting more retirees, with pension and healthcare obligations locked in by law and social contract. Tax revenues stagnate while entitlement spending soars. The only levers left are to borrow more, tax the young more, or inflate the obligations away. Each choice carries social and political costs. Japan has chosen the first path, accumulating debt without sparking inflation so far. But Japan is a closed, homogeneous economy with deep domestic savings. The US and Europe are not. Their debt is held internationally, their populations diverse, their political systems fractious. The margin for error is vanishing. This demographic debt trap is already reshaping policy in ways that appear benign but carry profound implications. The U.S. Inflation Reduction Act, sold as climate legislation, is in part a fiscal maneuver to redirect capital toward productive investment, hoping to boost long-term growth and tax receipts. The European Union, S2024 Debt Resilience Framework, quietly allows member states to exceed deficit limits if they invest in strategic autonomy. These are desperate attempts to grow out of debt rather than confront it directly, but growth is slowing. Global productivity has stagnated since 2010, and the low-hanging fruit of digitization has been picked. Without a productivity renaissance, which would require massive coordinated investment in education, infrastructure, and innovation, the debt burden will continue to grow faster than the economy that must service it. Herein lies the final paradox of the Great Debt Reset. The very institutions created to prevent chaos are now constrained from acting decisively. The Federal Reserve's independence, once its strength, is now a liability in an era demanding fiscal monetary coordination. The IMF, designed to be a lender of last resort, lacks the resources to backstop a systemic crisis involving major economies. Its total lending capacity is less than 1% of global GDP. The World Bank, focused on development, has no mandate to manage sovereign insolvencies at scale, and national governments, paralyzed by polarization, cannot agree on grand bargains. In the US, entitlement reform is political suicide. In Europe, debt mutualization remains taboo in Berlin. The system is trapped in a collective action problem. No single actor can solve it alone, and no coalition can agree on a solution. Thus, the reset proceeds not as a coordinated plan, but as a series of improvised adaptations, each rational in isolation, catastrophic in aggregate. Currency swaps replace reserve accumulation. Digital wallets replace bank accounts. Bilateral trade pacts replace multilateral rules. The global financial order is not collapsing. It is bifurcating, then trifurcating, into competing spheres of monetary influence. This fragmentation increases transaction costs, reduces efficiency, and heightens the risk of miscalculation. In a multipolar monetary world, there is no automatic stabilizer, no lender of last resort with unlimited credibility. The safety net has holes, and the fall through them will be long. The truth we must confront is this: the era of cheap, abundant, and stable money is over. It was an anomaly of the post-war period, sustained by American hegemony, demographic tailwinds, and technological leaps. We are returning to a more historically normal state, one of scarcity, volatility, and hard choices. The Great Debt Reset is not a conspiracy, nor a sudden event. It is the gravitational pull of arithmetic reasserting itself after decades of denial. And it is accelerating because the window to manage it gracefully is closing. The longer we delay honest reckoning through growth, reform, or restructuring, the more the burden shifts from balance sheets to societies, from financiers to families, from markets to militaries. History does not repeat, but it rhymes. And the rhyme we are hearing, the one echoing from Rome's debased coinage, from Weimar's wheelbarrows of Marx, from London's post-war retreat from empire, is growing louder with each passing quarter. The question is not whether we will pay the debt. It is how and who will bear the cost.